Good morning, good afternoon, or good evening, everyone, depending on where you're joining us from around the world. My name is Richard Anderson, and I'm the founder and CEO of ShareVault. It is my pleasure to welcome you to another one of our many thought leadership webinars. Over the past several years, we've hosted webinars and web panel discussions covering a wide array of business topics, including M&A, working capital management, fundraising, and cybersecurity, just to name a few. Today, we take a look at bankruptcies and corporate restructurings with the experts from Alvarez & Marsal. On behalf of the many contributors who have collaborated to make this event possible, I thank you for joining us. This is the 77th in ShareVault's webinar series, and our topic today is Pivot to Cash, Bankruptcy and Restructuring in a Distressed Environment. Before we begin, I'm going to cover briefly a few logistical items. We'll conduct a quick audience poll, and then I'll introduce you to our panelists. Following that, we shall kick off the presentation and discussion. Audience questions will be incorporated into the discussion, and we've also reserved some time at the end for a Q&A session. As a reminder, this is a 60-minute event scheduled to run from 9 a.m. to 10 a.m. Pacific time. Also, your individual audio will be muted in order to minimize background noise, but if you have any questions you'd like our panelists to address, please submit them at any time through the Q&A feature located in your Zoom webinar control panel. We'll try to get to as many of them as we can. And lastly, our panelists have generously offered to make the slide deck and a recording of today's presentation available. You'll be notified by email when they are released. We also welcome your feedback after the webinar, which enables us to improve our future webinars. So please take a moment to reply to the survey we send in our post-event email. And now it is my pleasure to introduce our contributing organization, Alvarez & Marsal. Companies, investors, and government entities around the world turn to Alvarez & Marsal for leadership, action, and results. Privately held since its founding in 1983, A&M is a leading global professional services firm that provides advisory, business performance improvement, and turnaround management services. When conventional approaches are not enough to create transformation and drive change, clients seek A&M's deep expertise and ability to deliver practical solutions to their unique problems. With over 4,500 people across 4 continents, A&M delivers tangible results for corporations, boards, private equity firms, law firms, and government agencies facing complex challenges. Their senior leaders and their teams leverage A&M's restructuring heritage to help companies act decisively, catapult growth, and accelerate results. They are widely recognized as experienced operators, world-class consultants, former regulators, and industry authorities with a shared commitment to telling clients what's really needed for turning change into a strategic business asset, managing risk, and unlocking value at every stage of growth. To learn more, visit www.alvarezandmarsal.com or taxand.com. That's TAXAND.com. Today's webinar discussion is hosted by ShareVault. At ShareVault, we frequently work with companies seeking to realize maximum value during the complex, multifaceted merger and acquisition process, where key contracts, intellectual property, employment agreements, financial statements, and other documents must be both secure and accessible to select parties. ShareVault is used in many other types of transactions as well, such as private placements, IP licensing, venture capital financings, public offerings, and restructurings. ShareVault customers experience a positive business impact because we accelerate due diligence, reduce risk, increase productivity and efficiency, and reduce cost. ShareVault also complements the tools you're already using, such as Box, Dropbox, Office 365, SharePoint, and DocuSign. And today, we are thrilled to announce the release of ShareVault version 5. This update complements ShareVault's new, sleek, modern look with an array of usability enhancements, including new and improved analytics and reporting, best-in-class native file protection, offline viewing capabilities, and many other features which further differentiate ShareVault as the most advanced and secure business file sharing solution available. If you haven't experienced our cloud-based solution firsthand, please reach out to us and schedule a demo or set up a free trial. Visit us online at sharevault.com. And it's my pleasure to introduce the members of today's panel, starting with Brian Fox. Brian is Managing Director and Co-Head of A&M's Eastern Region Restructuring Practice. Brian, welcome. Please tell the audience a little bit about yourself.
Thanks. So I have been at A&M for 4 years. I've been in the restructuring business for the last 30. So I've seen a number of cycles. One of the things Benjamin Franklin said, I think, is that history never repeats itself, but it always rhymes, sort of. And clearly, this is not a repetition of a cycle that we've seen before. So I think this has been interesting for us from a professional perspective and from a cycle perspective, as I'm sure it's been interesting for all of you.
Thank you, Brian. Thank you for joining us. Our next presenter is Christopher Howe. Christopher is a managing director with Alvarez & Marsal Tax & in New York, focusing on restructuring tax matters and merger and acquisitions transactions. Christopher, we appreciate you joining us today, and will you please tell us a bit about yourself?
All right, great. Perfect. Been practicing for over 20 years. Started my career with a few of the big four accounting firms. I joined Alvarez & Marsal 12 years ago, partner in our national transaction tax practice and one of the leaders of our restructuring tax initiative. So happy to be here today and just overlay, an overlay of the tax consequences to restructuring and the current M&A environment, and kind of complement what Brian and Reno are going to have to say today. So thanks for having me.
Thank you, Christopher. Up next is Reno Nori. Reno is the managing director with A&M's Global Transaction Advisory Group. Reno has provided financial due diligence services to private equity and corporate clients on more than 650 merger and acquisitions transactions. Reno, please take a moment to introduce yourself.
Thanks, Richard. Hi, my name is Reno Nori. I'm a CPA and I'm a managing director of the Global Transaction Advisory Group. I've been with A&M about 10 years, and prior to that, I was with PricewaterhouseCoopers also for about 10 years. So I've been doing this line of work for about 20 years. At A&M, I like to say I'm on the healthy side of the business, sort of counter to what Brian does, but we'll get more into some of the acquisition and divestiture activity that we're seeing later on.
Great. Thanks, Reno. Appreciate it. And lastly, I'd like to introduce you to today's panel moderator, Mira Leonard. Mira is head of client and business development at Alvarez & Marsal Tax & Mira, please introduce yourself and feel free to take the podium when you're ready.
Thank you, Richard. We're delighted to be here with you today. I lead client and business development for our tax practice. I've been in revenue generation for professional services firms for couple of decades now, and we are happy to be able to share with the audience today how A&M brings our integrated approach to both distressed and healthy organizations. So again, happy to be here with, and like you said, if we are ready to go, I can take it away from here and go to our agenda and the topics that we'd like to cover today.
Sounds great.
Excellent. Let me see. There we go. Here's a high-level overview of what we'd like to share with our audience today. We'll start with our restructuring trends. We'll share our playbook. We'll talk a little bit about alternatives organizations see today. Reno will talk about the M&A considerations and the market trends. And we'll close with some of the best practices that we're seeing from our clients. And before we jump into the framework, I'd like to take a moment and set the stage. Brian, you and I have had a number of conversations related to the current market and economic conditions. Maybe we can start with you sharing a little bit about what you're seeing.
Sure. So, I mean, what I found particularly interesting is, as a restructuring professional, when I think about pivot to cash, it's all about creating liquidity to cushion the negative impacts of the new COVID world, if you will. I was frankly surprised to see, and I don't recall the exact number, but it flashed up kind of quickly, that sort of 30%-ish of you out there, I think that was the number, had an increase in revenue as we went through the cycle. And I probably shouldn't have been surprised, because when I think about companies here in New York like Fresh Direct or Walmart or Dick's, or the fitness companies, the food companies, the paper companies that are supplying paper products, the PP&E companies, they needed to pivot to cash for a slightly different reason, right? They needed to increase their rate of production. They needed to increase their staffing. They needed to increase their working capital. And the pivot, when you think about the speed with which this came on us, many of us were traveling on March 9th and locked down on March 12th. So this was an unbelievably quick pivot and an unbelievably quick cycle to come upon us. And there is nothing that most companies could have done, or any company could have done, really, from a contingency planning perspective. So if you take a look at the next slide, where we sort of get into the meat of it. The pivot to cash playbook, when you think about what actually happened, the pivot to cash came in a couple of different ways. It came from a lender perspective, right? Most companies that had the ability to do it drew down on whatever available liquidity they had as quickly as they could. That was a relatively new phenomenon because I think folks learned from 2008 that once the banks shut you down, you don't have access to that liquidity. The banks actually responded pretty well to that. They worked with their lenders to triage what they needed to deal with now and what they could afford to deal with later. I'll talk a little bit more about that in a bit. But when you think about the restructuring activity to date and the way that it sort of has come about, we've seen a lot of retail and we've seen a lot of energy. Those are two industries that happen to have asset-based lending as being very prevalent. And when you have asset-based lending and you're out of money, you're just plain old out of money. So the companies that had cash flow loans or cash flow revolvers or otherwise had access to cash have had some leverage in negotiating with their lenders. During the second and third quarters, lenders were generally flexible to companies. They allowed them to maintain the liquidity levels that they drew down on. They offered sort of longer covenant holidays than I've seen. I mean, an 8 or a 9-month covenant holiday extending through the end of 2020 was not uncommon. And they really worked with good management teams to see what was going to come next. This came, though, at the expense, more often than not, of a liquidity covenant. So the message here to the market was, we're with you, we're your financing partners, but we're going to maintain enough liquidity in this business such that if you fall below that and we need to go a different direction from a restructuring perspective, we're going to have enough liquidity to execute against that transaction. There was also the CARES Act, right? And that came in a number of different flavors. Chris Howe is going to address that in a few minutes here. And then there was the multitude of things that came along with that in terms of support for the economy. Many of these forbearances, though, they expire between now and the end of the year. As we were sort of sitting there in March and April and May, as I said, lenders were willing to give you through the end of the year. Most companies had enough liquidity to get here, which frankly was a surprise to me. I thought the liquidity would have run out before the covenant holiday would have run out, based on the way the amendments were structured with no operating covenants and a liquidity covenant. Seems that wasn't the case. I guess that's because the economy has been performing probably better than most folks expected. The financial markets being where they are has created a wealth effect that I think has made consumers feel a little better about where they are. But be that as it may, banks are expecting to have to get back to the table with their borrowers, I think in the late third and fourth quarter, to have longer term fixes put in place. And many lenders expect another wave of restructurings to come in the third and fourth quarter, be they in court or out of court. And when you think about where they're sitting from a reserve perspective, on a relative basis, they are reserved in a very similar way against their loan losses as they were in 2008. The thing that's different between now and 2008 is they actually have their charge-offs are much less. So when you think about what the banks were doing is that they were making the deferrals on payments, they were putting up loan loss reserves, but they haven't yet charged, they haven't actually done the restructuring, so they haven't had the charge-off experience. And that's sort of what creates the uncertainty in the financing markets, the uncertainty in the restructuring market, quite frankly, as to what's going to come next. So as we advance to the next slide, we think a little bit more about what pivot to cash means for us. Best-in-class management teams realized that they had to either eat lunch or be lunch, as I like to say. I was also surprised that over a third of the audience anticipates growing by acquisition. that I think is one of the hallmarks of a best-in-class team. They were quick to draw on their sources of liquidity, and I don't mean just from the financing sources that I talked about just before. I mean drawing down inventories, working closely with their supply chain to create liquidity, either through terms or through unique sort of bespoke arrangements which would allow them to elongate their cash cycles. Of course, that slid all the way back through the supply chains. And they made immediate changes in their footprint. They furloughed workers, they let workers go. That was an unbelievable, painful experience. And they worked really, really quickly to right-size their infrastructure in a way that it could be brought back flexibly. And I'm not just talking about everybody working from home, because I think most of America doesn't work from home. And most companies, you can't make building supplies in your living room. You can't deliver food to stores from your living room. Most folks still had to go to work, and you had to restructure your overhead and restructure your actual operations. It's not just about the overhead in a way that would allow you to bring it back. And the other thing that best-in-class companies have done, and it's sort of borne out by the survey results that I've talked about, is position themselves with that available liquidity to take advantage of the opportunities that the market is giving them from a revenue perspective, and to take advantage of the market, the opportunities rather that the market is going to give them from an acquisition perspective as we move through the third and the fourth quarter. So I think the restructuring activity in the third and the fourth quarter is going to be a combination of out-of-court restructurings, in-court restructurings, and M&A, some of which is going to happen in-court or out-of-court. And which flavor of restructuring you pick is going to be dependent upon the most sort of efficient way to execute that transaction. And that's sort of, from a macro restructuring perspective here, how I think we're looking at it.
Right. Brian, should we bring Chris here and ask him to talk a little bit about the tax standpoint and in-court, out-of-court options?
Certainly. My ability to talk about the taxes is limited.
I think, Mayor, I think first I'll talk about the CARES Act a little bit before Brian and I maybe revert back to in-court versus out-of-court as a side-by-side discussion. But, from the CARES Act perspective, the government generally uses tax policy to provide liquidity and help out in economic downturns. This is regardless of administration. Back in, after 9/11, the Bush administration put in place a 5-year NOL carryback in the 2002-2003 timeframe, and then the Obama administration also provided what's called a 5-year, but is really more like a 4.5-year NOL carryback during the 2008 and 2009 economic collapse. So it wasn't without surprise that, the current administration, regardless of political affinity, would use the tax code and tax policy to drive liquidity into the economy. I think one of the key focal points here as the CARES Act was being negotiated was that the relief was supposed to be used for kind of an ongoing operations. So there's a lot of nuances on which policies you qualify for with different employee credits. They had various tax incentives for small companies with less than 500 people. They had incentives for larger companies. The big takeaways were that companies were able to defer their portion of the FICA tax from March 2012 through the end of, from March 2020 through the end of 2020, and basically it's a deferral on that obligation that does not have to pay it back until 50% December 31st, 2021 or December 31st, 2022. Again, the purpose there is to provide liquidity and be able to enable ongoing operations. One of the other major, I'd say, adjustments was, again, related to net operating losses. As mentioned before, the government had a historical precedence of providing a 5-year carryback. In the 2018 tax reform, the regular 2-year carryback that was codified or was in the books was taken off, and NOLs no longer had carry forward expiration periods, but you couldn't carry them back. The CARES Act provided for 3, 4, 5-year carrybacks to provide liquidity into the marketplace. This was specifically instrumental in a lot of the restructuring clients that Brian and I advised on over this past year. We had a few clients that were on we'll call it the edge of administrative insolvency, meaning that whether they can actually execute a plan of reorganization and get it approved through the court through a Chapter 11 process, or whether or not if they were administratively insolvent would have to be, say, forced into a Chapter 7 liquidation. The NOL carryback and the liquidity provided in numerous examples was a material factor in keeping these companies over that edge of insolvency, or one of the material factor points. One of the unintended consequences of the CARES Act, I'd say, and we'll get into this a little bit with Reno on the M&A transactions, is that these companies took these tax attributes or these NOLs and carried it back and provided cash. But if it wasn't used for ongoing operations, and let's say these companies went into a sale process of assets, it is likely that they would have a gain on these assets, and they no longer have the NOLs because they carried it back. So was the cash that was being used from the NOL carryback have to now pay the actual tax obligation on the sale of the assets. And so again, the takeaway here is that, from a tax perspective, it could get a little complicated. The CARES Act did provide liquidity, but we want to make sure that we're understanding how the NOL carrybacks and how these incentives are playing into the decision-making policies of M&A transactions. So, I think that's a nutshell on the CARES Act and the liquidity provided through tax policy. I know, Mary, you teed up, and Brian, maybe I'll throw it back to you for a few minutes on, just restructuring in general, absent of CARES, in court versus out of court, what you're seeing in the current market, and then I can layer back in some of the tax aspects on that.
Chris, just one note. Brian wanted to make a comment, so I wanted to open it to Brian here for a minute.
I think one of the things when you think broadly about what the government has done here is the stimulus, the CARES Act or the PPP. People talk about stimulus to the economy. From my perspective, there's no such thing as the economy. There are like 100 million families in the country who have to buy food and pay tuition and pay for cars and houses and stuff. So that money that went into the economy was largely spent. And so when Chris talks about things like using your tax attributes, but having to sort of repay that tax, if you will, because you have no attributes to hide gains, to shield gains, rather, in the event of a transaction. What that says to me from a restructuring perspective is speed and quality of execution in the M&A market is really going to have a premium as you go forward, because lack of execution and companies that have used the stimulus and are just hanging on by their fingernails to get to a transaction are going to make for some very tough sledding, I think, in the months ahead.
Thank you, Brian. Chris, was there anything else you wanted to add here, or we're ready to move on?
No, I think again, I'd like to maybe, Brian, if we could talk about in court versus out of court in general restructuring.
Sure. I think from a pure restructuring perspective, in court is better, right? It's out of the spotlight, it's less expensive, and it's often faster. And I say often, not always, but it's often faster. So what's important from an out of court perspective, it's just like an M&A transaction. It's speed, certainty, and price. And the way you get speed and certainty in an out-of-court restructuring is by having the ability to put all of your constituents around the table. So if you have a clubbed-up group of banks or a clubbed-up group of private placement note holders, and you can put them around the table, and you're, a sponsor-backed company, you have a higher likelihood of being able to do something out of court. If you've got public debt and a large syndicated bank group and private and public equity, it's going to be more difficult to build the consensus that you need out of court. And if you're sort of a private company that's at the edge of trying to figure it out, the analysis you have to do is what is the cost of going into court, and how much of that will you save by keeping it out?
So I'll layer on that, because from a tax perspective, it may be counterintuitive, although from the business perspective, 100% agree with. It's obviously better overall to do it out of court from a cost perspective, speed, certainty, efficiency, et cetera. However, when you look at what the cost it is and you're side by side, in court versus out of court, may be surprising, but in court may actually give you a better tax answer. And the reason for that is that there's certain bankruptcy exceptions that are provided in the code for companies in bankruptcy that give them either relief or better elections or planning opportunities to preserve and maximize their tax attributes. Generally the assumption out of court would be, the company, if it's on, again, the edge of a restructuring or is a depressed company, they may feel like they have tax attributes to cover themselves with NOLs or basis, or perhaps there's even a book loss that they're projecting and they haven't paid taxes for a while and it's kind of an unintended consequence. What happens is that when you have a material modification of debt out of court, that CODI income or cancellation of debt income from a tax perspective does not get the benefit of the bankruptcy exclusions. And again, it's a whole other tax-specific webinars or whatnot on the details of that. But I think the takeaway needs to be that these bankruptcy exceptions may be worthwhile from a tax perspective, but the saying that I always use, you don't want the tax tail to wag the dog. So, even though there may be a tax cost of doing it out of court, it still may be well worth it. And so, Brian, your point was you need to understand all the costs in court and out of court. Well, tax obviously is going to be one of those lenses that we're going to layer on, and it's something that they clearly have to be aware of from a decision-making standpoint. Now, in practice, in general, what we try to do, or what a goal is, can we actually show a side-by-side transaction where you're indifferent, where you actually have a tax posture from the current transaction where it's not going to create a cash tax liability or isn't going to cause friction or claims or anything that would stop on the certainty or execution. If you can be indifferent from a tax perspective, you can focus solely on the transaction or the restructuring. If out of court does have a tax cost, at least you can at least put it on the table there.
Right. Thank you, Chris. And as we know, we spent a great deal speaking about restructuring, but we all know that businesses have other options, as the slides point out. And Reno, I'll be calling on you now for you to tell us a little bit about the market and what alternatives you're seeing with our clients. What are they evaluating?
Sure. So, as I had said before, I represent sort of the healthy side of the economy at A&M. I'm a partner in the due diligence group. Most of the work we do, a lot of it is private equity. We've been doing a lot more corporate, and we are on the forefront of buy side and sell side due diligence. I'll get into kind of, the trends we're seeing and what's causing this now. We're just busy. The last month and a half, the spigot's really turned on big time. We're busy on a lot of the same stuff we saw before, just full normal transactions of family sellers and private equity firms, ending their holding period and selling, et cetera. But we are definitely seeing more of a sprinkling in of different types of transactions than the traditional ones. SPACs are one that we're seeing quite a bit of. Obviously, that's gotten a lot of attention in the press. In some of the early days, we saw quite a bit with pipes, especially where equity valuations were at least a few months ago. We're seeing a lot more carve-outs, and that could be carve-outs of a plant. It could be carve-outs of a business unit. It could be carve-outs of some aspect, frankly, of anything. And, sometimes that's to raise capital. Sometimes that's to get out of, to focus on other strategic things. We're certainly seeing more, the sale of more distressed assets, probably kind of attached to the stuff that Brian is seeing. We see the other side of it. And in general, sometimes there's no other reason other than the sponsor or the owner or the corporate just needs to raise capital. So, we're seeing maybe unnatural times of exits coming to market. It's simply for no other reason than to raise capital. But by and large, we're pretty busy.
So listen, let's take a minute to talk about M&A considerations and current trends for the upcoming quarter. So let's move on to that. How about that?
Sure. So let me back up, a couple of months here. Brian, I think you were talking about this pivot that occurred in early March. I mean, I remember where I was on March 11th and 12th. I was away on a deal, and things. I was getting the text from the school system closing down, and the management meeting I was in. Everyone's like, it's not nothing. Like, I mean, I flew home that night, and almost instantly like that, just the world shut down. I mean, I think it's one of those moments in life. I think we're all going to look back and remember where we were in that that sort of second week of March. I know almost all the processes that I was personally on came to a halt. One or two things completed, but almost everything did. Everything on the buy side, everything on the sell side really did. And to back that up with some data, the North American M&A deals declined by 35%, in volume and 73% in value this year compared to last year. Our colleagues, though, so I'm a generalist, and what that means is I do a lot of manufacturing, consumer, restaurant, retail, business services. But our colleagues who focus on purely software, technology, insurance, and some specific healthcare verticals, for a lot of obvious reasons, those M&A processes really haven't slowed down at all. But by and large, getting back to kind of M&A in general, as I said before, there really has been a rebound. I'd say May, the phone started ringing more and more about stuff maybe picking back up. It was a lot of head fake stuff that wasn't actually hitting yet. I'd say by early to mid-June, we were really facing a steep ramp up in our activity and our deal flow. Again, to back that up, just a stat here that for deals that range from 150 million to 5 billion in enterprise value, July this year saw 171 deals close, and that's close compared to 70 in April. So, and if you think of it now, closing is the final stage of a deal, right? That's kind of probably a lagging indicator of the level of activity that's going on. Obviously, as I mentioned before, I personally spend a lot of time in the private equity world, and depending upon how you measure it, there's something from a $1.5 trillion to $2 trillion of what they call dry powder that needs to be spent, and that's just private equity. That's not even counting all of the corporates' money that's still there for companies that have been able to stockpile cash and spend it. So that's one of the recent things we're seeing, and it seems like except for working from home, it's back to M&A work as usual.
That's great. You want to zero in on what's to come in terms of Q4?
Sure. Yeah, sure. So if we could advance to the next slide, this is going to kind of help explain the story of what to come. I mean, I mentioned the dry powder of what's causing this. It feels, and I've been doing this for 20 years, it feels like every few years, come this time of the year, there's always some sort of race to get things done. This one seems more intense than I've ever seen. There's this time is of the essence on every single transaction that we're involved with. Everything needs to get done today or yesterday. Obviously, I mentioned the dry powder. I think that there's still some short-term concern about the COVID. Some of the concerns have eased, at least in the short term, but there's still this long-term unknown, right? About the general economy, about when actual real sustainable earnings will return. So if something looks like it's okay and it's stabilized now, I think people just want to go ahead and grab it or exit it. There's obviously, the gorilla in the closet is the election, right? And I think day to day, that which way that's going to go, obviously whatever headline you read, right, you can get a different view of that. But obviously there's a lot of unknown and a lot of uncertainty around that, and what the subsequent policy decisions will be after that. And then obviously there's even if the current administration remains or there's a new one, right? There's this ongoing geopolitical set of issues that we have to deal with, protectionism and trade wars and things like that, stuff that we've been seeing now for a while. But again, it's all stuff that impacts a company's, supply chain, their ability to trade globally. And where, again, I think while things are sort of known, at least in the short term, people are just trying to get things done, right? One thing I heard in the beginning of COVID was, when things come back to life, the bid ask between what a seller is going to be looking for to sell his business for, and what a buyer is going to ask is going to be quite a spread, right? And it's going to prevent deals from getting done. I'm not seeing that, particularly on the deals where the business is relatively healthy. If there was COVID, you can put a box around it and you can adjust for it. I'm just not seeing that, and I think that's the basic supply and demand force that's keeping values afloat. We'll see what happens as months go on, but at least initially we're not seeing that, especially with some of the assets that have come to market. What we are seeing though, and remember, I play on the sell side, I also play on the buy side. We're certainly seeing COVID normalization adjustments. This creative term called EBITDAC, earnings before interest, taxes, depreciation, amortization, and COVID. We're seeing anything from very simple, hey, we had some extra costs for PPE, maybe paid workers an extra bonus to remain incentivized, but that's really it. We didn't really skip a beat, to businesses where there was a definite shift in revenue, a definite slowdown, but it's rebounded. You can put a box around it, you can see it, to the ones where, extreme example of of a sporting venue that hasn't come back yet and people are trying to figure out, well, what was lost. So we're seeing all sorts of adjustments like that. And I think where the adjustments get a little bit more, at least in my world, get a little bit more creative, that's where you're doing your best, sellers are doing their best to point buyers toward, the 2021 forecast. And hey, you got to almost ignore 2020, and we've got to look beyond this. And that's really what you need to be caring about. And again, going back to some of the points were raised earlier by Brian, which of the companies really took this time to restock? And granted, maybe things are not back yet, but they've really redone their supply chain. They've streamlined their back office. And how are they going to look coming out of this thing? Chris, I mentioned the election as being, one of the things driving this. And obviously, I think some of the candidates have released some of their high-level plans. What's your take on this, Chris? Do you see tax being considered here in some of the things you're looking at?
Yeah, Reno. I think you hit on the head too around just the execution and want to close deals now. A lot of the deals that we're seeing right now are being pushed before year end because they think that in the Biden administration, any tax changes would be retroactive, say back to January 1st or back to the election day, whatnot. And so, individuals or investors who are holding through flow-through structures are very concerned about this, from a tax rate perspective, to be able to pay back the deficit and all the trillions that went into all the legislation that we mentioned earlier. What I would say also is so Biden has, unlike previous elections, Biden has not released a detailed plan. However, he's very clear, and I think he's on the record saying he's going to, quote unquote, get rid of the bulk of the 2018 $2 trillion tax cut. Some of the stuff that both Biden and Bernie were talking about during the debates seemed to be consensus to move the corporate rate from 21% to at least 28%. There was also talk that Biden had in different debates and presentations where he has suggested a 15% corporate AMT tax that would basically be on global net income. You'd still be able to use losses and credits, but that 15% kind of minimum tax on global net income would prevent, large corporations with sophisticated tax planning from having an effective tax rate lower than 15 or close to zero. That would apply to corporations above 100 million. But again, some of the nuances there, I think the takeaway is, the devil be in the details and if a Biden administration comes in. But the point is that, assuming that they maintain at least the one house of Congress, and if they got the second, that he will try to unwind the bulk of the 18 tax cut and or at least keep some of it in place, but move the rates up. Like, the corporate rate went from 35 to 21, maybe it's an adjustment back up to the 28%. So that's where I'd say that just keep an eye out in the press for that, but it is clearly driving an incentive to execute and close deals before December 31st this year.
Got it. Chris, are there other considerations though that you'd want to point people to as we enter the fourth quarter, at least from a tax perspective?
Yeah, I think a lot of this is stuff I mentioned before. I mean, the short-term liquidity, obviously, where we covered on the CARES Act, just overall kind of defer tax payments. I know we're working with a lot of companies that are looking at what penalties or interest would be if, even if it's things like property tax or other things, and, just scheduling out the payments on deferrals, or if they can get exemptions or rebate from certain state and local jurisdictions. For our global companies with international footprints, there may be what we call trapped cash in different jurisdictions because there's a withholding tax to bring it back. But again, it may be worth paying or structuring around those withholding tax liabilities in order to access that. And again, pursuing refunds. And those refunds aren't just the NOLs, but just scrubbing your overall tax posture and seeing, with certain state jurisdictions, there may be open audits, or there may be items where you paid in, and you have an ability to accelerate those negotiations to get that short-term liquidity. Again, long-term liquidity in Q4, you want to make sure that your operational structures and your actual preservation is right. And Brian, you noted that the polling question, it seems a lot of the participants, at least on this call, either their companies or their clients, are working on business transformation right now. And again, a lot of times, tax is left to the end to kind of be solved for later after business decisions are made. But I just encourage everyone to have your internal tax representative or your external advisor kind of at the table when you're thinking about supply chains, when you're thinking about treasury approach, workforce planning, et cetera, and how the cash tax impacts that.
Do you see any differences between what a private equity or their portfolio company versus a publicly traded corporate from a tax perspective that they need to be mindful of, or is it just the sort of stuff before?
Yeah, I think that's similar stuff as before. Private equity, right? Cash is king, right? Cash taxes, looking at what their expected hold period is, 2, 3, 5 years. They also want to make sure that they're structured in a way to be desirable on exit, so that they can offer certain what we call step-up transactions and provide, a good tax structure on exit. So it's really cash tax planning, where our public companies are really focused on their effective tax rate, earnings, their public disclosures, very more strategic, very much more with tax systems and tax integration into their overall kind of operations. So I don't think that has changed so much historically, but it is a good reminder that, if you're within a public client versus a private equity and or your clients, what those kind of incentives are.
Thank you, Chris. And I'm conscious of time, so I want to bring it back and address this to all three of you. And Reno, let's start with you, right, in terms of what are we to expect in Q4 and M&A?
Sure. So, as I said, we're busy, and the M&A market is busy. Obviously, I think if I'm a buyer, you'd want to take advantage of some of the distressed situations, but it's I think the headline for this slide should be really much buyer beware, where because we see what's happening on the sell side. There's a lot of hungry sellers, there's a lot of hungry buyers, right? And obviously, where the two intersect, there's a transaction, right? So I think you want to take advantage of certain situations, but be cautiously optimistic of them. Nobody knows 100% what's happening with COVID and when this is going to end and what the new norm is. So when you start looking at things on a COVID adjusted basis, just be mindful of it. I don't think anybody can tell us when we're coming back fully with certainty and what that new normal will look like. So again, I would just be careful of that when you're thinking about transactions, valuation, and the long-term ability to sort of ride the wave out. Just be mindful of that. We're certainly seeing companies that have, and rightfully so, taken advantage of, the government programs, all of the things that Chris spoke about. Obviously, as a buyer, you want to make sure you understand how does that impact the financials. Does that impact the income statement? Are you inheriting certain, obligations like PPP loan obligations? were there rent abatements or rent deferrals, and what are landlords going to do? Do you have a liability that's just been kicked down the curb? So I think you want to be mindful of all of those things. We've certainly seen companies that have done well throughout this, and had a great tailwind. And I think you got to understand companies that have maybe COVID has given them the step change that they need to, business to go online and have less brick and mortar presence, and maybe that's permanent. Or is it a temporary tailwind? The simple example I gave is a toilet paper distributor, right? Obviously I can't think of an actual company that does that. I'm sure there's plenty of them, but there's definitely instances like that where there's been a COVID blip, and again, you want to make sure you're not buying on some pop that's just going to go away. And then again, it's getting back to the medium and long term effects of the presidential election, and just understanding what the outcome is of that. I don't know, Chris, if I've left anything off that, again, if you want to bring back to tax, and if not, maybe Brian's got some comments just in general on distressed assets in the market.
No, I would just say, to your point, all those tax planning and tax items I covered, just make sure that whether they're treated as debt-like items, like you said, where does the liability from that cash that happened, and what happened to those obligations and those programs that they entered into, and how do those liabilities sit in the balance sheet? Are they assumed liabilities or debt-like items as part of the structuring and closing the transaction? So just be mindful of it, and I'll turn it back to Brian.
I think from my perspective, we're sort of back to where we started on the pivot for cash, right? Really good companies that do acquisitions have 100-day plans. They know what they're going to do on day one, 30 days before they close, and they have execution plans and PMOs in place in order to get from here to there. In this case, I think the environment is just uncertain, right? We don't know if there's going to be a second wave. We don't know what the impact of the stimulus wearing off is. We don't know what the wealth effect that's been created in the financial markets has caused, if that goes away. And I think you need to have sort of two sets of contingency plans around your 100-day plan. One is, what happens if shortly after or at some point during those first 100 days, while we're learning the business, what happens if the bottom falls out? Where are the levers to turn off the cash flow at the spigot? Because that's where you got to turn it off. You can't stop spending cash. You got to stop incurring obligations. How do we do that quickly? And on the flip side, what happens if there's a negative economic consequence or a negative virus-related consequence that has a positive business outcome for us, and we need to ramp up pretty quickly? Where are we going to find that cash? Who's going to provide it? Do we have enough dry powder coming into this transaction, combined with our contingency plans to pivot in either one of those directions? Because what the financing markets are telling us is that the outcome is uncertain at the moment. And I think best-in-class companies are going to be prepared for that uncertainty. Otherwise, they're going to find themselves in a potentially difficult situation early into a transaction with their lenders. I think the same goes for companies that somehow made it through the cycle without the need for a significant restructuring, and perhaps the amend and extend worked, and you can extend further and redo your credit facilities, and on you go. I still think you need to have those kinds of contingency plans, at least for the first 3 quarters of 2021.
It's funny, Brian, on the transaction side, I sometimes view, it is, sometimes I'm a pipeline to your work, Brian, and I've seen, some of my clients who execute deals do it very methodically. They're very carefully. They model a lot of the downside scenarios you're talking about, and then they just do simple. They just apply less leverage. It's very basic, and the ones that are more aggressive end up being pipeline for you guys, unfortunately. And then look, there's clients that have done it the right way, and you just ended up in the wrong industry. I mean, I think with COVID, some industries have been very fortunate, and some have been not so much, and nobody would have known, 6 months ago or 7 months ago where the dice would have landed.
I think that's right, and I think when you put what the two of us are saying together, one is you have to do the modeling and adjust the capital stack the right way. The other is you have to have real operating plans in place. And you have to do both. If you do one or the other, it may not be a recipe for success. You can't just say, we took on less leverage, so we'll be okay, because less dollar leverage with the same covenants perhaps doesn't work. Or, their whole, I think you need to do both sets here, both sides.
Absolutely.
Listen, thank you to the three of you. I think this is a nice way to wrap up this segment. Richard, I'm going to hand it off to you. I know we might have a couple of questions that we want to address, and we can get back to the public, the audience, with questions that we don't have time to address later on.
Oh, that sounds great. Thank you, Mira. And thanks to all the panelists for an excellent presentation. Very insightful and a lot for us to take away from. So let's go ahead and, before we sign off, why don't we go ahead and take a few questions. And Mira, if you can guide us through that part of the conversation, that'd be great. And then we'll wrap up after that.
Sure. Thank you, Richard. Here, I have a couple of questions here. One of them is, how do we adjust for next year? And why don't I start with Brian on this one? Brian, how do clients adjust for next year?
We stay on the balls of our feet, right? We become ready from an operating perspective and from a capital structure perspective to pivot the way we had to in March when we weren't ready. We over-communicate. We communicate with our employees as to what we expect from them. We communicate where we're at. We communicate what our plans are as it affects those employees, so that they build trust with the management team as we go through a cycle. We communicate with our stakeholders, with our lenders and our equity partners in the case of private companies, so that if there is a need for capital, we're helping them see around the corner as that need is arising, and we're not showing up with a check for their signature, not having communicated what the issues are, how those issues are building, how they could unfold, what the management contingency plans are. So I would say, how do we adjust for next year? It's not a question of adjusting, it's a question of preparedness. Most companies have adjusted to make their businesses flexible. Those who haven't are no longer with us or are owned by somebody else at the moment. And those that have, you need to stay on the balls of your feet, and you need to be proactive in communicating.
Right, Brian, you and I talked a little bit about this in terms of companies being able to innovate and leverage digital tools. They're the ones that are agile and adapting. Well, Reno, Chris, is there anything you'd like to add? Reno,
no, hey, Mira, I do see another question did come through here about after the webinar, if there's any other questions. And I think Mira and Richard, I think you guys will be circulating our contact information. Is that correct?
Absolutely.
That is correct. And Reno, were you trying to respond to the last question?
Yeah, sorry, I was on mute. No, I was just saying I didn't have anything to add for Brian. I wasn't sure the participant who asked that what the sort of what their situation was, but I think it's exactly what Brian said.
All right, we have time to address one more question, right, Richard? We have a couple minutes left. Is that correct?
Please go ahead.
All right. Yep. Let me just pick one here. We've already seen retail and energy. What industries seem especially susceptible to the need to restructure in the next wave? Brian, this comes to you again.
Yeah, I mean, given where the economy is, we look at hospitality, and it seems that the airlines have access to the capital markets, but they're probably going to be flying at reduced schedules, which means buying less planes. So we're looking at the, not so much the Boeing, Airbus, Embraer, but their supply chains. There's going to be a tremendous amount of pressure on their supply chains, I think, and those will either be restructured through, through acquisition or through restructuring. I think with the OEMs, and the same is true in auto. I think looking at the auto financing deals that are available, no interest for 6 years, no interest for 7 years. Clearly, any forecast you look at has a decrease in auto manufacturing, and to the extent that you have suppliers that operate on thin margins, I think those are too. I think we're done with retail. I think if you were retail and you made it through here somehow, you're in good shape. And I continued to say for the last 4 or 5 years that we were done with energy, but they continue to pop up as capital continues to flow in there into that space. But those are the 2 things I would look at.
Okay. Thank you, Brian. Reno, Chris, do you have anything that you'd like to share based on what you've seen with clients?
No, I don't. I mean, I think with M&A, you know, it's going to be with industries that are still suffering. You know, people obviously trying to do one of 2 things. You know, where there have been tailwinds, right? Try to get on those, and if you haven't already, you know, you need to. You know, just think of the things you've done personally in your life. You know, I'll take pets for an example. Everyone seems to have gotten a pet, so we've seen a lot more pet food type deals coming to market, or pet care or veterinary clinics. You know, so obviously where COVID has shifted certain behaviors, you know, I think that's obviously you want to get in front of those things, where, you know, maybe there's some lingering issue like hospitality and things. I think people are going to look to see, okay, where is the bottom? And, you know, I will aggressively and speculatively go after targets that are there and that are hopefully rounding the corner soon. So I think we're going to see a lot of that next year as well.
Yeah, and from a tax perspective, again, I just, you know, it's the lens that gets layered over everything that Reno and Brian said. I mean, you know, if it's energy, there are obviously specific tax incentives and you know, nuances within, say, depreciation and tax consequences of energy versus manufacturing versus financial services. But, you know, basically it's just a layer over of the work that Reno and Brian is doing just to make sure that, again, whatever industry you're in, that you're just planning. I think Brian's point of communication and preparedness should be the key takeaways here.
Excellent. Thank you. Richard, I think we're about at time. We have a couple of questions left, but like I said, we'll follow up with the audience afterwards to make sure we address them. Thank you. Thank you, everyone.
Sounds good, Mira. Appreciate it. Thank you so much. Brian, Chris, Reno, thank you for sharing your vast knowledge with us and with the audience, and to Mira for moderating the panel. It's great to be with you all today. And thank you to the audience for joining today. Audience, be on the lookout for an email in the next few days that announces the availability of the recording and the slide deck. And for all of us here, we sincerely hope that the information you've learned or revisited today will be of great help to you. So in summing up, we wish you all good health and a wonderful remainder of your day.
Thank you, Richard.
Thanks, everybody.
Thank you, everybody.